next 2 days to we'll be talking about valuation. In fact, the program ends on Wednesday. So the program ends on Wednesday. So today and Tuesday and Wednesday, we'll be dedicating a whole period to valuation and investment decision making. Those are the things we are going to be doing. It's going to be exciting as always. And it's good you guys have been here to this point. Tell me so far, how are you taking the lectures? Are you learning something? Am I challenging some views that you initially have? Tell me something. I want to read some few things in the chat in the next 3-5 minutes before we delve into the business for today. So I'm waiting to read some things in the chat. So I have a number of people. So Richard, Cephas, Nelson, Ibrahima, Ezekiel, welcome here. And Richard and Cephas, let me hear from you. I've not heard from you, both of you. Let me hear from you. Let me hear from both of you. Okay. I think we will need to kickstart quickly with the business of today. And let me see, try to get my Excel open. Have you all received the Excel? They share with you some Excel. I hope you've all received it. Yeah. So Ezekiel said, superb lessons. I've been wowed so many times by the new things I'm learning. Great. That was totally different from what you studied in class. Yeah. Yes, SL received. Great. Okay. So now, let's quickly get in. I don't know why this document is delaying, trying to open. Okay. Yeah, faith society. Okay. Good. My everything open now. All right, so talking about the business for today, how are we going to do? I'll wait for this to, okay, so it's open now. Please confirm if you can see my screen. Let me have the screen shared while I see whatever I want to say before we commence the class. Please confirm if you can see my SL screen. SL screen I'm sharing. Please confirm if you can see that. Yeah, let me see. Who can see? Good, good, good. Now, so the business of today, what we're going to do is that we going to um, take the first 10, 15 minutes to talk a bit about our model, and then we'll proceed from there into valuation, right? So let's take the first 10, 15 minutes to look at our model. I promise you, what's this? Oh, sorry for that. Now, so I promised that I was going to complete the model. I'll work on the base case assumption, and which I did. So now our model is completed. So when I come to the objective here, I have the base case model, and then I can use the drop down button. And when I change from this is a base case model. If I change from this base case to best case, you see the performance results changing, and also when I can move from best case to worst case as well, and you see the result changing as well. So this is worst case, what we didn't do last time, and I went to do it. So when I go to the financial statement, so moving to the financial statement that we had, you see this is the best case financial statement. I didn't do anything apart from those assumptions we all agreed on. Those were the things I linked. So we have the base case also done. So our financial model is set. Now, there are some two things that I want us to do before we confirm that we are fine with our financial model. The two things are these. Number one, you recall when we started this work, we didn't look at dividends. We didn't consider dividends at all in our forecast. We didn't look at dividend. Now, so let me just go to that side, and we need to come up with an assumption for dividend. So that's the next thing we need to do. So the base case model here, there's a dividend policy side created. So these are the dividend policies I created for a base case model. So we need to come up with a dividend in the base case world, and then we will proceed to look at the dividend in a world where we have the best result and a world where we have the worst result. So I don't know why 2024 here, there's no dividend assumption. Let me just check something quickly. So if I go to equity, component of equity, I see dividend paid. Dividend paid 2024. The dividend is not yet, was announced in 2025, right? So it's not part of crossover we have here. So that's the reason why when you go to the assumptions, you don't see any calculation on dividend. I mean, anything on dividend payouts, right? So we're going to come up with dividend payouts for the periods into the future. And what we do is we can look at maybe 25%. We can work with 25% in an ideal world. If I see an ideal world, I mean the base case scenario, right? 25% throughout. Now, for the worst case scenario, so these kind of things, when it comes to the dividends, and maybe we can still go to the scenario triggers, and so we put that also there. So I go to the scenario triggers. I want to create something for dividend. So we can look at dividend policy, and here we will talk about so dividend payout. Then we have the best case dividend payout. and dividend payout. Okay, dividend payout. So I have these are the dividend payout ratio. I'm going to not applicable throughout historical, but in a forecast, the adjustment we're going to do, we are not going to do any adjustment to the base as we always do, but to the best, we're going to increase. Generally, uh, we, when you make more profit and you are even paying the same 25%, it tends to be big, right? Even in when we look at the best case scenario, if we look at the base case scenario, we are making a dividend of 25%. In a best case scenario, that may not necessarily mean that you're going to pay more than 25%. But here, let's say that in a best case scenario, we are paying 10% dividend above the base, right? In a worst case scenario, what we are going to assume is that a dividend for West should be below base. Yeah, I get it. So the worst case scenario, what we can even assume for the worst case scenario is that we can even assume that nobody dividend will be paid because that's the worst case scenario. The bank is not doing quite well. Why would you want to pay dividend? Okay. Or another way we can handle is that in the worst case scenario, in the first 2-3 years, no dividend will be paid. Maybe dividend will be paid somewhere in the fourth and fifth year, right? Something we can assume something like that. In that case, we assume the base dividend from the 2028, 2029. But in the earlier years, we will not assume that any dividend is paid, like no dividend will be paid. But then, how do we model this out? If we are saying that no dividend will be paid in the first 2 years, how are we going to model that out? I think there's a comment in, let me check this. I mean, it should be corrected. You type above base. Oh yeah, above base, but then it will be negative. So above base, if I say negative 3% above base, in other words, I'm trying to say below, right? That's the meaning. You can see that the best case scenario is 10% above the base, but worst case scenario above base, negative 3%. Of course, I'm going to change these things, but I hope you get a whole logic. Yeah, great. Now, so what we're going to do here is that we want to put something here such that the base case dividend, the worst case dividend is 0. Okay, no matter the level of base case dividend, since we are predicting things based on the base case scenario. One thing we can do is we will assume that whatsoever the base case is, let me check something. For example, if you have the base case being 25% and you want to make this 25% 0, one way to do that is to subtract 100% or to make a growth at 100%, and that will make it 0. Okay, good. So what you do above base will be negative 100%. So we don't want any dividend to be paid. So if we add negative 100%, or if we grow here we're not going to be adding things, right? We are going to be multiplying things. If we multiply let me put it somewhere. Multiplying growth. So this one, what is going to happen is that whatsoever we're going to be looking at here for the worst case is going to be growth in the payout ratio. I want it to be so for just the worst case scenario. Okay, negative 100, negative 100. Now, so we're going to do or project a growth rate rather than whatever rate. It's going to be, we'll project it as a growth. Okay, the growth in the dividend payout ratio. Okay, having done this, we go to the base case scenario and we adjust that. So we look for dividend payout ratio, and that is this in the base case. So, okay, there's no need for adjustment for base case. We go to let's say best case scenario. That's what I was trying to say. Best case scenario, what is it? It is here. We take the base case as we have it, and we add whatsoever is a scenario trigger, best case. Then we drag. So this is what we have for best case. Now, for worst case scenario, I said we are going to do something a little different from what we did for the other one. So we have the base case already here. What we're going to do is that we will multiply this by 1 plus whatsoever the growth rate should be. And then I go to the trigger, I do this, and it must give me 0. Good. It gave me 0 in the first year, but subsequent year, I have the 25% from 2028. Okay, so this is the dividend policy. Now, let's incorporate this dividend policy. So we solve our first problem that we want to solve within the 15 minutes. I'm not really even looking at the time, 15 minutes. Now, so this is the dividend paid, right? The whole idea is that the payout ratio for 2025, let's assume that each payout ratio will be paid in the year that we are estimating. Okay, 2025 payout ratio will be on 2025 profit for the year and will also be paid at the end of the year. Let's make that assumption. That's a big assumption, but let's make it. The payout ratio, 25% we are projecting for the base, will be paid in the 2025, the year 2025 itself, right? I'm paid in the year 2025. So what do we do? But I realized that there is something we've not looked at. Did we look at the live to check whether the dividend side is also linked? Let's check whether the dividend side is linked in the live. These are the things we did some time ago. A lot of things we did. Yeah, it's linked. It's linked. It's linked. Currently, my model is on, I think it's on the worst case scenario. So you can see that the worst case is peaked. Okay. So I go to the equity, go back to the equity, and I'm going to link that. So I'm having the profit for the year, but don't forget this profit for the year must be in the calculation of the dividend. We don't just use the profit on the P&L like that, because there are some regulatory thresholds that you must meet, right? That you need to be able to adjust for maybe those transfers to credit risk reserve, transfer to statutory reserve. Those things must be done, and whatsoever is left, that's what you calculate the whatever on, right? So all I have to do here is to link. Oh, I think I have in a formula here, guys. We have actually done a lot of things in the past. I have in a formula here, linking all these things already. This is a dividend payout. The formula is already here. Okay, the formula is already here. Have you seen it? And then also, when you check, the way I actually build this formula is that earlier I told you that assumption we should use is to look at the payout for this year multiplied by the profit for the year. But what is actually being done here, which I built up, is payout for this year used to multiply the profit in the past. I think that's fine. There's nothing wrong with that. It's okay. We can go with that. But that being said, since we are multiplying the payout for this year against the previous year's profit, it is actually in place to make the best case dividend equal to the base case dividend, at least for 2024. So I'm making this 10% 0. Now, coming back to the equity side here, we have, this is in the worst case scenario. So this is what we have as the total dividends that are calculated. Now, let's check our balance sheet structure first to see whether the balance sheet is in balance. And it must be in balance because we've linked all these things. Oh, there's a problem. It tells us that dividend might not have been linked. Perhaps we didn't link dividend. So it's throwing this error here. So when I go to cash flow statement, let me check if we've linked dividend in the cash flow statement. Dividend paid. Oh, dividend paid has been linked. So what's the problem? All right. So we go to the same equity and check some few things there. Go to equity. So we have dividend calculated here. Then we also have to reflect in the retained earnings, and that has not been done. It's not been linked to retained earnings. And so when you pay dividend, it reduces your retained earnings. So let's link that quickly. We have that link. And now when we drag, our balance sheet should be in balance. And whichever scenario we intend to run, the balance sheet will always be in balance. Let's check it out and see. Now the balance sheet is in balance. Have you seen that now? Now let's switch between scenarios to see how the balance sheet is looking like after switching between scenarios. Let's go from West to, let's say, base case scenario. And you check that the balance sheet is in balance with the base case scenario. If you check this, the model is in order. And if you come to the equity side as well, you see that we have the dividends well calculated. Have you seen it? This is the base case. Have you seen the dividends here? And if we move to the other one, which is the other scenario, which is, let me cancel this. When we move to the other scenario, which is the best case, the best case scenario, when we check that also, you realize that the model is still will be in order. You have the written earnings. You see the 25% in 2025, then 35% throughout. And then when you move to look at the balance sheet, our balance sheet is in order. So that is it so far. So that's for the dividends. One last thing to go. Now, when we go to the equity section, there is something I want us to do before we move. I told you that we're going to do that later, and that is this. We have the regulatory reserve. The regulatory reserve, there is a formula we need to put here such that every year, based on your profitability and also the stated capital you have, an amount may have to be transferred from retained earnings to statutory reserve at the end of every year. Okay. Now, so that value that have to be transferred is actually or how you should calculate the amount to be transferred is part of the banking sector. How to call it, the banks and other depository institutions, the art, right? The banking art. Okay. So let's check the banking art now. Let me see where I can find it. So I think I downloaded it sometime. Banking art. Otherwise, we can still download it. So let me download that quickly, and then we check it out from there. We download the banking art. So banking art Ghana. Banking art. Let me see at 9:30. See, I may not have to even download all those kind of stuff, right? We can just read it right away. I'll share my screen, then we can read it. Okay. So let me share the screen so you see what I'm talking about. Then we all read it together to see where or how we should calculate the statutory reserves. Okay, so this is a banking art. Now, the banking art here, let's look for statutory reserve. Statutory reserve, or let's just look for reserve. I think the word reserve alone will be fine. Okay, cool. So we are here. Let's check this out. So reserve fund. Okay, it starts from here. A bank or specialized deposit-taking institution shall establish and maintain a reserve fund into which shall be transferred out of net profit for each year, where the amount of the reserve fund is less than 50% of the paid up capital, the amount of the reserve fund is less than 50% of the paid up capital. So the paid up capital is the stated capital. So if the amount of the reserve fund is less than 50% of the paid up capital of the bank or special deposit taking institution, an amount which is not less than 50% of the net profit for the year will be transferred, right? Now, if the reserve fund is 50% or more, but less than 100% of the paid up capital of the bank or specialized deposit taking institution, amount which is not less than 25% of the net profit for the year. And where the amount of the reserve fund is equal to 100% or more of the paid up capital of the bank or specialized deposit taking institution, an amount equal to 12.5% of the net profit for the year will be transferred. All right, so look at it. The transfer required under subsection 1 shall be made before the declaration of interim or final dividend and after making provision for taxes. Okay, good. That's the reason why we cannot calculate tax dividend directly on the profit. It must be the profit less the movement. So let's check it out. So we are saying that if the reserve fund is less than 50%, we will transfer up to 50%. Okay, from net profit. If the reserve fund is more than 50 but less than 100% of the stated capital, we will transfer an amount up to 25%. And if the reserve fund is equal to or 100% or more, equal to 100% or more of this paid up capital, then we transfer only 12.5%. Okay. Now, that being said, let's go back to the Excel and do the computation. Let's put in there, you see how this thing, let's model this thing out there. So transfer from retained earnings, how do we do it? So it's going to work like this. So if, let me zoom in. So if, now, so the condition is that if the opening balance of the statutory reserve is less than, okay, is less than 50% of the stated capital, which is this, okay. If it is less than 50% of the stated capital, then the answer should be a 50% transfer of net profit. So that's profit for the year. We transfer 50%. Okay. Now, comma. So the second condition is that if the first condition is not fulfilled, then you move to the next condition. So which is if the same reserve account is less than 100%. So in other words, what is going to happen is that it's going to check the condition for 50%. If the condition of 50% is not met, then it's now going to move to the condition for 100%. Meaning, since I've checked a condition of 50%, it means it's now going to check between 50 and 100. How is it like, right? If it is less than 100%, then 100% of what? The stated capital, then what happens is that you are going to transfer only 25% of profit for the year, which we have here, right? Okay. Otherwise, what do you have to do? Otherwise, you are going to charge 12.5%, 12.5% of the profit for the year. Let me see the number of this thing I have to close. Close the first one. I think that is it. Good. So this is the formula. So let's check which condition is working here. If you check the stated capital is 500 million. Okay. Now, the way my Excel sheet is formatted here is just funny. All right. So 500 million, right? So if we do 50% of the opening balance of the statutory reserve, what will it take us to? Well, definitely the 50% of the statutory reserve is less than, um, oh, sorry, I'm making a mistake, please. If we take the statutory reserve, and we do 50% of the stated capital, the 50% is 250,000. Clearly, the statutory reserve is more than 50% of the stated capital. Okay. Now, why not checking 100% of the stated capital? 100% of the stated capital. Well, the statutory reserve is 914. It's more than 500. So that condition is still not checked. So the last condition is that the stated capital is more than the statutory reserve is more than the stated capital. In that case, only 20 or 12.5% of profit should be transferred. Let's check whether it's 12.5% of the profit that is transferred. So we do this divided by the profit for the year, and you see it's exactly 12.5%. Let me put there so that you see it's exactly 12.5%, right? So the condition is fulfilled, so we can drag. So these are the transfer to statutory reserve. And then that transfer to statutory reserve will now be deducted from the retained earnings. Okay, so the amount is transferred from statutory reserve, from retained earnings to statutory reserve. So that's what we've done. And with this, a lot of things might have updated, but total equity is still the same. But few things will update. How dividend is calculated, the amount of dividend that you'll be paying will now reduce, right? So if you check the dividend that is being paid now has drastically reduced over time, all because we need to ensure those conditions are fulfilled. So moving something from statutory reserve, from retained earnings to statutory reserve doesn't change the total equity, but it affects the dividend you paid at the end of the day. And also to say that the amounts that have now moved to statutory reserve is not available for distribution to shareholders. In other words, you can't take it to pay dividend another day. No, it's not available for distribution. It's increasing the capital base of the bank. The bank's capital base is increasing so that the bank can actually take more risk. Because think about it, you are making profit and you plow back some into the business, right? And you plow it back in the form of this. So this is a statutory reserve. You are reserving this by law, so it supports your capital base, right? So think about this as a CapEx for the bank, as the bank's investment in capital. This is the bank's investment in capital. And this is going to be very important to us when we start doing valuation, which we will do today. So a lot of things will change. Some key things. So those are the two things I want to talk about, which I've just finished talking about. So few things will change. Some graphs I've plotted here will change. Some of them will start changing. And let's see the areas that will change. What are the two main changes we did? We did changes to dividends. And the second change we did was to, I was on the statutory reserve. So a change in dividend for dividend and statutory reserve. So which part of the graphs are likely to change? Definitely, it will be return on equity and return on asset. They are likely to change. So when I go back here, this is best case scenario, and this is return on asset for best case. Let me update the graph here. Return on asset for best case scenario. I'm updating my graph. And this is return on equity, the after-tax return on equity for best case scenario. And then I do the same for, I change this and do for worst case as well. So for the worst case, look at the return on asset for the worst case. So the worst case return on assets is this. And then the worst case return on equity, oh my goodness, was very low in the earlier years for the worst case. Very low. And then we move this back to the base case. So the base case scenario, this is the return on asset for base case, and then we do for the return on equity as well. So our graphs are fully updated. I have to be copying and pasting as numbers because I can link that to that side because of the scenario. So things have changed, but then you see the movement in the various. So you always see best case being higher, okay, better than all of them. Cost to income ratio, base case is recording the most efficient one. Non-funded income to income ratio, blah blah blah. You see all those kind of stuff here. All right. So financial modeling is done and is over. We are done with financial modeling. The next place to go is valuation. So we're going to move a little bit from the Excel, and I'll take you through some basic valuation theories. And from the basic valuation theories, we now channel the discussion down into the valuation. Just seconds, please. I'm checking something quickly before I share my screen. Let me check this. A moment, guys. Checking something quickly. Okay. Okay. Just a second, please. Let's see. Okay. I think okay. I can do this now. So I can actually introduce this now. Okay. Now, so guys, let's start with the valuation. Let me share my screen now. We're moving a bit from the Excel. We'll come back to Excel when we start the actual work. And so I want to ensure that I'm able to finish intrinsic valuation today. It appears as though we're going to be doing a lot of stuff, but we should be able to complete intrinsic valuation. Please update me if you can see my screen. Can you all see my screen? My PowerPoint. Is it visible to you all? Is my PowerPoint visible? All right. Okay. Thank you very much, Kuku. Now let's look at this. So valuation of equity instruments or equity securities. Now, so we're going to talk a little bit about today. The lesson will be on intrinsic valuation methods, right? I want to complete intrinsic valuation method because I want to dedicate the entire of tomorrow to relative valuation method. But then I'm hoping strongly that if I'm not able to finish intrinsic valuation method today, because tomorrow is for only relative, and for banks, the relative valuation methods we use is not going to present a lot of difficulty to me. I can take part of tomorrow's time to complete the intrinsic and then complete also the relative. Now, the way the lesson is going to go from today to Wednesday is that when I finish relative tomorrow, God willing, then we know we have our valuation result. The next thing we're going to do is to analyze the valuation result. And that is going to happen on Wednesday. Wednesday, we're going to analyze the valuation result. We'll come out with so a lot of tools for analysis. We will use scenario methods and simulation techniques like Monte Carlo simulation. We'll run a simple Monte Carlo model on the final result to see the probability distribution of the estimated values over different time spans, right? And then we'll come up with price targets and all that, try and find a way to estimate price targets and all those kind of stuff, and also take a look at what is happening on the stock market for the stock in question and all those kind of stuff, right? We will look at that in details, right? Now, so today, let's look at an introduction to valuation. I picked this from the CFA curriculum, and that is from Grossman's Stiglitz, Paradox, Stiglitz or Stiglitz or whatever. The whole idea is, why do we do equity valuation? And this is the whole idea. Because look, if you have a company listed on the stock market, the company is listed. When you go on the stock market there, you are going to see the price. You see the stock price is visible, but then why do we do valuation? Now, so he came out with a paradox that I found very interesting. And he says that if market prices, which are essentially freely obtainable, you can go out there and get a price. You don't need to pay to observe the price of GCP. Okay, you don't have to pay to observe the price of Apple, right? Now, so if all those market prices are essentially freely obtainable, which perfectly also reflects a security's intrinsic value, let's take it that case, then a rational investor will not incur the cost of obtaining and analyzing information to obtain a second estimate of the security's value. So if the market price is out there, we can go out there and find a price, the price is so and so. If that is it, and we can freely observe that price on the market, we can freely get of course, know the trading price and everything, then as a rational investor, why do you have to incur additional costs to calculating that or to calculate that value again? Now, because the security prices are already reflecting the fundamental information about the firm, right? Now, but this is the case. If no investor obtains and analyzes the information about a security, however, then how can the market price reflect the security's intrinsic value? In other words, how do we know that the market price of the security itself is correct? Okay. How do we know if the price is correct if we have never taken time to do a second check, right? To value to see if the price at which it's trading is accurate or not. You get a point. How do we know if we never conduct evaluation? So that's the reason why, even if a company is listed, even the most liquid market, we still do valuation for the stocks, even in the most liquid market, right? That's just an argument for that. Quickly from there, how does the valuation process look like? Okay, regarding the valuation process, it involves first understanding the business. Of course, we need to have a good understanding of the business. And what it also means that if we say understanding of the business, we need to understand the competitive market within or environment within which the business operates, including the macro considerations, right? Regarding GCB, we've taken much time to dig around the banking sector, understand the sector performance, understand the peer groups and all that. We've done that, right? So once you do that, you forecast the company performance. And have we done that? Yes, we did. We forecast the company performance. We've done all those things. Here, I put this presentation in generic form. So you see sales and all those kind of stuff, right? Yeah. Then the third thing is that you convert the third thing is that, sorry, the third thing is that you select an appropriate valuation model. So you forecast the company performance and all that, then you select an appropriate valuation model, and then you convert your forecast to a valuation. And finally, you apply the valuation conclusion. So as it stands now, we've done the understanding of the business, we've done the forecasting company performance. We are coming to do the next side. So it has to do with selecting appropriate valuation model and also converting forecast to a valuation. And then Wednesday, we will do applying the valuation conclusion. So today and tomorrow will be on selecting appropriate valuation model and converting forecast to a valuation. But again, to say, we have already dealt with cost of equity before in the past. So part of the conversion of forecast to valuation has been done already. Now, broad approaches to business equity valuation, you see the familiar ones, the intrinsic valuation approach. So intrinsic valuation approach, you're going to see soon that it looks at the company fundamentals. And based on the company fundamentals, we are able to estimate what should be the company's value, right? So in other words, we use the intrinsic valuation method, or when we use it, the assumption we are making is that we have a complete information about a company. And you may not have a complete information about a company, right? In other words, you are able to analyze the underlying fundamentals and the potential future cash flows of the business. That's what you're doing. There are multiple models that are used for intrinsic valuation. We have the free cash flows, the dividend discounted model, the residual income model, and all that, right? The relative model is more of the show me your friend, I'll tell you your character. So we maybe similar assets their values tend to correlate, right? So we can use the value of item A and item B to determine item C. Think about a situation where you find yourself in maybe an estate, and then you want to estimate the price of or the value of your building, but you know the value or the price at which some recently sold buildings or some buildings were recently sold. So based on the price at which they were sold, you can actually use that to infer the price of your house as well. So we are valuing this company relative to the value of so and so company. In other words, we know some company's value, and based on that, we're able to estimate our company's value, right? Now we can use strategic options, also use to value this kind of stuff. But then these things are more so to value very complex instruments, more of like, let's say, convertible bond to value the equity element, those kind of stuff, right? And also executive share options and all that to value all kind of stuff. You can use that to value equities as well. The Monte Carlo approach tends to be one of the best methods actually in recent times. Is gaining much popularity than even a use of the fundamental method. A lot of guys that are in the advanced world doing finance, they don't use the intrinsic value and relative valuation when they are doing trading on the market and to see which stock will outperform and all those kind of stuff. They don't tend to even care about the intrinsic valuation. No, to do all this intrinsic valuation, one thing you're actually doing when you do fundamental analysis, which includes the intrinsic valuation, is that you try to forecast a company's cash flows, over time, a company's performance. But what you're doing, you are just forecasting a single path that the cash flows will follow. Oh, today is 2 million. Tomorrow is going to be 2.2, 2.3, 5 million, 10 million. There's a single path. But the actual path taken by the cash flows may deviate significantly from the path you predicted. Yeah, you cannot predict a correct path, but Monte Carlo improves upon this using a quantitative approach. So with the Monte Carlo, I don't care about I don't care about company performance. I don't care about the balance sheet. I don't care about the P&L and all those kind of stuff. The cash flow statement, I don't care about it. I use the market price. But one issue also here is that we're going to be taking the market price as though it's correct, right? Taking the market price as though it's correct and use that as basis to do some stuff, to determine all that. You run some called the geometric Brownian motion, and these things you need a deep knowledge in mathematics to be able to handle those kind of stuff, because you require some level of calculus and kind of stuff, you geometric Brownian motion and solve the and the same we call it the process, underlying the stock price, the geometric Brownian motion, the process underlying the stock price. That process is already solved using calculus. You use that to solve, and with Ito's lemma and all those kind of stuff, and then we come up with the Black-Scholes equation. So it's the same process underlying it, or the process we use in the Monte Carlo is the same process that is used to solve for the price of an option. Maybe later in the future, or later, I'll come out with maybe not a web, maybe a 2-hour webinar, a 3-hour webinar, just to show how we can even value options and all those kind of stuff. Not using the Black-Scholes, but using Monte Carlo method, which is let's say it's more powerful than the Black-Scholes because it can handle a lot of other changes and assumptions, which the Black-Scholes have a lot of limitations to. So it tends to relax the assumptions in the Black-Scholes. And so this is used a lot on the market, right? A lot of the quant guys use it. Now, let's take an initial look at the intrinsic value. So now, what is the value of a business? So the intrinsic value of a business actually is a function of three things. Number one, the cash flows associated with the business. Number two, the growth potential associated with those cash flows. Or another way you can put it is that the cash flows from existing operations is one variable. The second variable is the growth associated with the cash flows arising from future reinvestment, okay, and also operational efficiencies. So we have the cash flow from the existing business. Then we also have growth potential in the cash, or the cash flow growth potential. And the third one is risk. So the three, cash flow, growth, and risk, are the three variables that actually determine the value of a business. So the big value of a business is a function of cash flows, growth, and risk. Now, so no matter the methodology we use, the cash flow, growth, and risk must always be represented in the way. So it's a fundamental way of actually thinking about valuation. And of course, as far as valuation is concerned, that is the core of it. So whatsoever we do, no matter the method we use, whether it's going to be discounted cash flow or intrinsic value based or relative valuation, we are going to be making assumptions around cash flow, risk, and growth. Now, I want us to talk or look at some basic propositions in intrinsic valuation. I want us to look at two propositions. One, because we are saying intrinsic value has to do with, and the key method there is the discounted cash flows, and it has to do with projecting cash flow for over a period and discounting the cash flows back to today, and then summing them up to give a value. Since we said that's the case, then it means the first proposition kicks in here that for a business to actually have a value, for us to calculate the value of a business and have it as, and have a value for it, in other words, have the valuation to be positive, its expected cash flow must be positive sometime over its life. In other words, you cannot have cash flow projected that is all negative, and then you do using that to do valuation. No. At a point in time, the negative cash flow should flip to positive, right? Otherwise, you have no value. Second proposition, that the businesses that generate cash flows early in their life will be worth more than those that generate cash flow later in their life. All of that things being equal. And this is coming from the concept of time value of money. So the earlier the cash flows, the higher its representation in the value. Okay, so cash flows that happen now are more valued than cash flows that happen in the future. Those are the basic propositions. Let's proceed. Nothing really difficult here. I brought in this in here. Let's talk about it. Called the equity valuation framework. Now, the framework here is simple. let's go back to the balance sheet. When we take a typical balance sheet, what is the accounting equation? The accounting equation is asset is equal to equity plus liability. Now, if we make equity the subject, then the accounting equation becomes assets minus liability is equal to equity. So you're going to see asset minus liability here. Then you see equity here to the other side. Now, asset minus liability must be the same as equity. Therefore, this balance sheet or this sheet must be in balance, or this statement must be in balance. Now, from the perspective of an accountant, when we present a balance sheet, the balance sheet is at book value. In other words, the total value of equity is at book value, and the total value of assets is also, equity side here too, is at book value. In other words, the value of asset is at book value, the value of liability is at book value. Here too, I make things a bit generic. Now, when you read these notes, I made a lot of things generic, but then some specific to the banking sector. Now, so what we do is this. To the accountant, these values are book value. But to the finance guy, these values or this balance sheet is not the typical balance sheet of the accountant. This balance sheet is, we can call it, and I often call it, the finance balance sheet. So this is the finance balance sheet. In other words, when we take the accountant's balance sheet, we look at our asset and ask ourselves, what is the market value of this asset? We looked at the liability and asked, what's the market value of this liability? So if we have the market value of assets, we have the market value of liability, how do we get a market value of equity? And that is all we need. So the market value of equity will be the market value of assets minus the market value of liability. Wonderful, wonderful. Now, so how do we get the market value of equity? All we need to do directly is that we can just directly go and determine the market value of equity. All we can do is that we can do that indirectly. We'll determine the market value of assets, we'll determine the market value of liability, and when we subtract the market value of liability from the market value of asset, we get the market value of equity. Good. Now, in that case, determining the market value of equity is the same as determining the market value of asset minus liability. Now, what is the market value of asset? We understand that the market value of asset is the present value of future cash flows associated with the operating asset of the firm. Okay, or let's just say with the asset of the firm for a moment. Now, so when I talk about asset here too, I mean the existing asset base and any reinvestment in assets. Because I mentioned to you that the cash flows we are looking at here are cash flows. I told you valuation is a function of cash flow, growth in cash flow, and then risk. Okay, so the market value of assets is actually the present value of the future cash flows associated with the asset and discounting that to the present value of future cash flow means it's been discounted, right? Now, why must it be so? We know something from accounting that a decision has to be made by the accountant at the end of the year, well, as to the value at which he should keep an asset. And there are some 2 points the accountant has to look at. The accountant has something we call the net realizable value. I think no, the accountant has something where it has to do what we call the value in use and then the net realizable value, right? The value in use here has to do with well, if I sell if I keep the asset and I'm using the asset, what will be the benefit associated or accruing to the firm? So kind of like the asset is so and so value today on the balance sheet. Well, I don't care about that. I want to look at, okay, so if I keep this asset, what benefit can it give to me? So I tend to project the benefit over time in the form of cash flows, discount all of them back. So well, the asset value is 100 million based on the benefit it will give me if I continue to use it, if I continue to hold it, if I continue to own it and benefit from its cash flows. So we determine what we call the value in use, which is the present value of the future cash flows associated with the asset. Then we also have the value to the company if the asset is sold, which we call the net realizable value. So in other words, if I have sold the asset now, what will be the value to me? The accountant will then have to compare to see which one is higher, and the higher one is the one the accountant is going to use. Now, bringing that same analysis here, the reason why we determine the value in this way, we want to maximize value, we determine the value in this way, is that we assume that the business is having a going concern. Because the business is going concern, we don't care about net realizable value. We don't care about how much you get if, let's say, we force sale the assets, right? We rather think about what's the present value of the future cash flows. Now, so what it means is that we take the present value of the future cash flow from the asset and we subtract the liability from it. But the beautiful thing with the whole work is that we can actually calculate the cash flows that are accruing to the asset minus the liability. Sorry, directly. Now, when we come to the argument for banks, it's even simpler because we understood that for banks, their operating assets is even the liabilities, the deposits, right? So they don't appear like that, right? So it's even easier to do the valuation for them. Now, so if I take asset minus liability and I come up with the cash flows, I'll discount the cash flow using cost of equity because the cash flows are equity-like. They are equity-like cash flow. Why? Because the cash flows are for asset minus liability. So since liability has been taken away from the asset, whatever is left is equity. Therefore, the cash flow associated with that is equity-like. So we discount it at the cost of equity. So this is where the cash flow is coming from. This is the cost of funding the cash flows. The cost of funding the cash flow is the cost of equity. It must be paid for by this cost of equity must be paid for by the cash flow from here. You know, it must pay for the cost of equity here. And so that's the whole idea. That's what we're coming to do, the rationale. Now, so the intrinsic value, there are three methodologies, a free cash flow model. We have the residual income model, and we have the dividend discounted model, right? When you use the free cash flow model, you either come out with the value for the firm or the equity model, right? If you come to use the residual income model, you are coming straight with the equity value. And when we use the discounted dividend discounted model, you are coming with equity value. What we are going to do going forward is that we are going to get into each of these. But let me say this. We are going to base our valuation on equity because I mentioned this to you from the very day we started this program that when we deal with banks, we don't talk about value of the firm. So free cash flow to firm doesn't work. Every valuation must be towards equity, right from the one. I said that. Good. Let me check if there's any question. There is no question. Let's get into things. So what I gave you earlier is just an introduction to the whole thing. Now, here, okay, I thought my screen has broken. I'm seeing some lines here, actually. I was a bit worried. All right. So the free cash flow to equity. So the free cash flow to equity is the cash flow available to only equity holders. It helps compute the value of the equity, right? So what's the formula for free cash flow to equity for a bank? So here, the concentration is on a bank. So here we look at the profit before tax. I want you to pay attention. Is the profit before tax multiplied by 1 minus tax. So we take out the tax from it, and then we subtract movement in statutory reserve. We subtract movement in statutory reserve. And then whatsoever is left is what we call the free cash flow. So that is free cash flow for a bank. And you'll be wondering, and I want to see, if you disagree with me, if you think there's something I've said here that doesn't really sit well, and you are not saying a number of things that you know on in this formula, you can put that in the chart. Now I'll explain why. But even if no one does that, let me bring out some few challenges. Number one, you are not seeing any depreciation here. Why no depreciation? Depreciation is non-cash. Because I took just profit before tax. I take out the tax rate. And then what I did next was to look at the movement in statutory reserve. Then I said that's free cash flow to equity. What the hell is that? But think about it this way. Bank depreciation is a small portion of a bank's business, right? A bank's financial statement. Banks, their main asset is not the physical asset you are seeing. The main asset of the bank has to do with the capital the bank has. So, like in coming up with cash flow statement or free cash flow calculation, we tend to subtract CapEx provision, right? Maybe projections or provision for CapEx, okay, capital expenditure. That we say, well, we have to estimate how much will be reinvested in CapEx and working capital and all those things. It doesn't work well for a bank. We don't waste time on those kind of stuff. And again, the statutory reserve here serves up just like the CapEx, right? Because the bank works with capital base and the manufacturing firms work with the physical asset base. So in that case, depreciation is a big thing. CapEx is a big thing. But here, the CapEx, think about it in terms of the movement in statutory reserve. That's the additional CapEx. In other words, you realize that before we started this lecture, when we took the financial statement, we transferred an amount from profit to statutory reserve based on a certain formula. And we look at that. So that alone shows us that we kind of like plowing back part of the profit to the business before we even pay dividend. We do that before we pay dividend. And the same thing happens when we deal with industrial corporates. When we're calculating the free cash flow, we take out CapEx provision, we take our working capital provision, our requirements before we arrive at the free cash flow. That is now out of that we pay dividend to customers. To shareholders. Same thing is happening there. So the movement in statutory reserve, take like the CapEx, right? Now, but well, if you still have some doubts, I can still make you happy by telling you this, that we should have added depreciation. Technically, theoretically speaking, we should have added depreciation. But you've forgotten also that capital expenditure for fixed assets should have been subtracted as well. So can you make a simple assumption to say that the depreciation and CapEx must cancel out? So even if we add back depreciation, we are taking out CapEx. Therefore, at the end of the day, there will be some cancellation. Yeah, we agree that the amount of CapEx provision is not the same as the depreciation expense for every year. I understand. But yeah, that is it. So it's a simple model, free cash flow for a bank. Very simple. Very easy to relate with. Now, once you come up with a free cash flow, you need to come up with what we call discount factors. Now, a discount factor is a present value of 1 cedi. Is a present value of 1 cedi. So, if I'm saying if you see a discount factor for the year one, a discount factor for year one is, let's say, to be 0.909. 0.909. That is to say that, or let me make it simple, 0.91, 0.91. That is to say that the present value of 1 cedi in a year's time, the present value of 1 cedi receivable in a year's time, today is 91 pesos, right? So discount factor is equal to the present value of 1 cedi. I think there's a question. Let me check. Let me respond to that first. I'm learning a new thing with deducting statutory reserve. What happens if the bank still goes on to do other CapEx? Take something like building, branch, and investment in PP. No, those are not big things. Those are not big things for a bank. Understand where you're coming from, but compare CapEx that a bank does every year in the statutory reserve. Which one helped the bank to exist? You know, when we started all this, I told you what is important to a bank. It's capital. It's capital. Those branches are not important to the survival of the bank. You can have those physical assets. If the Bank of Ghana is taking your license from you, there's nothing you can do about that. Okay, what is critical to the investor is not the physical asset. Now, the question you should ask yourself is that, can a bank choose not to do that and still survive? Yes, they can still survive. They can leverage on technology. Let me give you an example. EcoBank is not even in Volta region. Correct me if I'm wrong. There's no EcoBank branch in Who, but EcoBank has the largest deposit. And to last year, that GCB outperformed EcoBank slightly. It's still the second largest. You see, it's not about number of branches you have. That is not what the investor values. So whenever we do these things, we are looking at what does the investor value. What the value is the capital. For a bank, it's the capital. It had nothing to do with a physical asset. For industrial corporate, physical asset make a lot of sense. If you don't invest in assets, your business will collapse. But banks, no, they can still do so well without that. So nobody really cares about that. Investor won't come and put so much valuation on that. Look, those banks whose licenses were withdrawn in 2016 or 2017? I think that was 2017 when we have the sector cleaner, 2017. Those banks whose licenses were withdrawn, tell me, were they not having physical assets? Did they sack them from their premises? They were still operating. It's the license that was taken. And why was the license taken? Because their capital base is nothing to write home about. Capital adequacy had deteriorated. That's the most important thing. Hello, guys. That's the most important thing. Now, good. So what I'm doing is, yeah, you see this sign here. It is for all, right? The inverted A. It looks like an inverted A. It means for all, for all. So what I mean is that the discount factor is only calculated. We don't do it for negatives, right? We don't have a negative year. A negative, so it means that when you're calculating discount factor, it is year zero, which is today, then year 1, year 2 into infinity. So for all I greater or equal to 0, right? Sometimes if I use mathematics to write things, if I use mathematical notations, it's easier for me to communicate some things rather than having to always write them out. Now, so the value of equity is a free cash flow year I multiplied by the discount factor for year I. So you sum up that from year 0 to infinity. But we don't really forecast things into infinity. So at a point, we come up with a terminal value. Hence, that's what we'll be going to soon. There is something I want to talk about here, very critical, which a lot of people also don't do properly on the market. So listen carefully to this side. Considerations in forecasting cash flow for valuation. Now, using trailing 12-month financial statement. Now, before this, let me see you writing something in the chat box this way, right? I want you to answer a question for me. Now, if you want to value a company, we are in the month of May. You're in the month of May. Let's say we are today is July 1. Okay. Let's say today, no, let me just say we are still in May. Let's say I want you to value a company for me, any company at all, not necessarily bank. Any company at all, I want you to come up with the value of the company on the 1st of May. What's the value of this company on the 1st of May? I want you to make that assumption. On the 1st of May, what's the value of this company? But the company's financial statement date is December 31. Okay, the December 31 is the financial statement date. And I want you to come up with the value of the company on 31st of May. How would you approach the whole thing? Because you have historical data up to December. How will you do? I want you to write something in the chat. Let me see what you do. What will you do? What will you do? I want you to come up with a value on the 1st of May. And the last financial statement was published 31st December. What will you do? Let me see something in the chat. Quickly. We don't have time today. Let's see that quickly, guys. Anybody typing something? Sifas is forecasting using a historical data. Yeah, you are going to forecast using a historical data, but when will you start? You see, you must always have a point that you are forecasting things from. How are you going to forecast it? So we consider the period. Yeah, I get it. You are going to consider a period, but then how? Where is going to be the reference point for the forecasting? You see, what I'm coming to talk about here is where valuation projections tend to differ from projections for other purposes. Banking sector valuation appear to me to be simpler. If I'm doing a valuation for, let's say, industrial corporate, the cash flow projections, you may not like me because I'll tell you that look, all these things that people do, use even the way they treat things like loans and all those debt instruments are mostly wrong. You know, everything must be a market value. So even a financial forecast must assume that along that you are doing valuation or you are doing financial forecasting in a market value. For example, the interest charge. I'm not talking about banks. I'm talking about industrial corporate like manufacturing companies and all that. The interest expense on a P&L when you are projecting, the interest rate you are using should be cost of debt in the projection. You don't use interest on the loans. It must be cost of debt. The value of the debt that you use in the forecast financial statement must be market value of the debt. And you must estimate the market value of the debt. You don't use the one that was on the historical balance sheet. No. You see, so things change significantly. Isaac said, get a last 12 months, including Q1 2025. Yeah, you are going to get last 12 months, including Q1 2025. I get that. Well, I mostly will stick to the full year number. However, for my starting period, I use, in the case 31st May, 0.5 as my starting period. That's assuming that the January to May has already occurred. Okay, good responses, Isaac and Mark Jordan and the team. Good response. Now, let me put it this way. That's true. You know, the standard accounting reporting period is December 31 for the company, but it has to change. You are not going to use December 31 for your forecast. You are going to change the reporting date for the purpose of valuation. You are going to, actually, the best thing to do, if you have monthly data for the company, the best thing you should do is to reconstruct last 12 months. So you're going to get last 12-month financial statement. And that's what you're going to do. So if you have monthly P&L data for the company, you just create last 12 months with the reporting date being 30th April. You see, because my valuation date is May 1. Therefore, I'll reconstruct the historical to have a reporting date being 30th April. Then the forecast will now be done with 30th April being the reporting date. So as though the financial statement of the company is now ending 30th April. That's what you're going to use to do the forecasting. So you are not going to use the accounting method, reporting period, which is 31 December again. No. Now this will be based on a revised one. So if, let's say, we are in June, then you reconstruct the past to have a reporting date being 31 May. Okay, and that's the essence of the entire last 12 months that we have. So a lot of these last 12-month analysis we do in finance actually mainly to help us do things like this. Right. So let's look at it. I have a slide for that. So using trailing 12-month financial statement. So here, the valuation date may not be the reporting date, which is the December 31. However, whatever the valuation date is, you need to construct a 12-month trailing historical trading for the company, which could form basis for projections. Yeah, you reconstruct that. So I have something here I want to walk you through. Something here as guide. So let's think about this. So we have the 12-month trailing analysis. So what we do, we have the previous reporting date. The previous reporting date was December 31, 2023. Let's say we are valuing the company September 30, September 30, 2024. We are valuing the company September 30, 2024. Okay. And the previous reporting date, December 31, 2023. And let's assume that we are not yet at the end of 2024, right? So we know that we are valuing the company on September 30. If we look 12 months back, it's going to take us to 1st October 2023. That's the quarter 4 in 2023. So if I take quarter 4 in 2023 and I add it to the first 3 quarters in 2024, I have a full 12-month period. So that's why we have the 12-month trailing analysis here. Right. Now, so you are taking 1 quarter from the previous reporting year to add to this one. So now you have reconstructed a 12-month trailing. And all you can do is that based on this, you now have September 30, 2024 as your new reporting date. And based on that, you're going to do your forecasting. Now, we know the next reporting date is December 31, 2024. Don't go and say, well, I know that, oh, the next is 31 December. I'm going to do my projections based on 31 December of every year. And that will help me to come up with the value on 31st December. Then I discount the value back to September. No, it's not a proper way of looking at it. Otherwise, it's not a proper way of looking at it. So this is something that can guide you. Good. Let's proceed. Now, estimating free cash flow to equity for a commercial bank. I talked about this earlier. We take the profit before tax, we apply the tax rate, and the tax rate should be the marginal corporate tax rate for the industry. The marginal corporate tax rate, right? Not the effective tax rate. Then we have profit after tax. When we do that, we do the movement in regulatory capital, which is actually the changes or the movement to the statutory reserve. Then we have the free cash flow to equity. So this is what we're going to discount to get the value for the bank. Good. Now, so we'll project this over an explicit forecast period. Oftentimes, the explicit forecast period is 5 years. We do the cash flow projection over a 5-year period, then discount it. But we need to also be aware that the company is having a the assumption of going concern is there. And therefore, the company is going concern. Because the company is going concern, we must estimate the terminal value. There are multiple ways of coming up with a terminal value. But a simple approach you can use would be to look at the price to book multiples for the average price to book multiple for the industry. And you can use that to come out with the terminal value. And what that means is that the price to book multiple, you are going to, if price to book multiple is the market price divided by the book value, right? So if I know the book value at the terminal or on the terminal date, right, or at the end of my explicit forecast period, we are going to do all this in Excel, right? If I know the book value or on my explicit forecast period, at the end of the explicit forecast period, and I multiply the book value by the price to book ratio, then it gives me the price or the value of the business as at the end of the explicit forecast period. And that is my terminal value that I can discount back to today. Good. That is a multiple approach. The second approach for a going concern is a stable growth. Here, I would say that beyond the explicit forecast period, the bank's free cash flows will grow at so and so rate indefinitely. We can do that as well. Okay. And then we have the liquidating value approach. The liquidating value approach, oftentimes, we are going to hypothetically think about the business coming to an end. Of course, we won't assume that for a bank. Right. Good. Wonderful, wonderful, wonderful. It's been a speedy one. But, well, we've completed the free cash flow model. We are left with one other model to complete the intrinsic value. However, we are going into Excel to implement the free cash flow. And then from there, we'll start, of course, I think we will bring it to a close. Tomorrow, we will do residual income for the first 45 minutes or for the first 1 hour. Let me put it that way, because we may need to refine some things again. For the first 1 hour, we'll do the residual income, and the second 1 hour, 30 minutes. So tomorrow, guys, we'll start exactly 5 o'clock. We'll start exactly 5 o'clock tomorrow. So the next 1 hour, 30 minutes, you use it on the residual, the relative valuation, and then we'll bring valuation to a close. But more important of all those class is the Wednesday class. Now, let me go back to the Excel and let's see what we can do with the free cash flow. Let's do a valuation before we leave here. So this is my Excel. I hope you can see my Excel. I hope you can see this. Can you see the SL? Yeah. I think you guys can see. Yes, good. I want to put my model on the base case mode. Base case. Okay, base case is there. Okay, so let's create some worksheets here quickly. So we are going to, let's create something quickly. We call these value estimates. Value estimates. Value estimates. Okay. And then, so value estimation. Value estimation. I think, or let's call it equity valuation. Right? Equity valuation. So I can call this one to equity valuation. Okay, so maybe I can change the color. So use this color, and I need some few things. I need a dating. I mean the structure here. So let me change this. Let me put it at the very end of it and call this free cash flow to equity, right? Free cash flow to equity. And free cash flow to equity. So I have free spin data view. Let me cancel the free spin. And then here I can say free cash flow to equity. And let me delete everything below this. I'm looking for just the time. I'm going to manipulate that. Free cash flow to equity. I think there's somebody wanted to ask a question. Yes. Okay. Yes. Okay. Good. All right. So let's have this done here. I'm going to. I need to place this. Okay. I need to delete this Kaga column, and I need only 2024 here. There's a reason why I need only that there. And I'm changing all this. I want to format this. I don't want to be working and be having percentages everywhere. Okay. Everything changed. And what else? So what I'm going to do, I'm going to change it free or FCFE model. Good. I have an FCFE model. And what I will do is that, guys, this is very simple, right? We have the years here. We need to come up with some few things, but before then, let's put in here some key measures. We can call it earnings before tax. We have earnings before tax, then less tax expense, and then we have earnings after tax. Then we have movement in statutory reserve. Movement in statutory reserve. And then we have free cash flow to equity. Okay, so we will be able to have free cash flow to equity with these. by the time we get to this level, we have free cash flow equity. And then with the free cash flow to equity, we will now determine terminal free cash flow. Okay. We determine what we call terminal free cash flow to equity as well. I'll show you what that means in a jiffy. Then below this, we're going to have periods. So come a bit down here, we have periods. Then after periods, I didn't write this anywhere, so I'm producing this out because I've been doing this over and over again. So this is my big deal, right? So I have periods, and after periods, we going to have discount factors. And sometimes I tend to put the periods at the top, but I'm putting it here for a reason. So we can actually do the discounts factors here. We do the discount factors here, and below the discount factors, we will have. I want to extend this thing below. Below that, we will have below the discount factors, you have present value of free cash flows. I don't know whether I should. Free cash flows, equity. And then we also have present value of terminal free cash flow to equity. Flow to equity. So that's what we do. And then after getting these, then we have, when we sum them up, I have intrinsic value. Intrinsic value. And so we have intrinsic value here. Then after intrinsic value, then I'll show you what is next, right? After intrinsic value. So we're going to present the things here. Quickly, we can go for our earnings. So we take the earnings before tax from 2024. So what I will do is that I want to move the P&L to this side quickly. What is my P&L that we have? I'm moving it to the very end. I'm changing its position to this place. So I have earnings before tax and earnings before tax 2024. And then we extend this. And again, just before we proceed, I want to do this here. I want to do this here. I want to move the scenario. I want to put a scenario at the top here, right? So it's not like we are going to be changing things here. We will finally see something, right? We will finally move the button to where the final result will be, and that's why we'll be doing a lot of the scenario simulations and things. So we'll move the button to that side soon. So I have this painted yellow. Okay, so base case. Okay, so currently we are doing base case. I just want to know that we are doing base case, right? I want to introduce one more slide. Maybe it's not necessary for now. I think it's fine. The way it is now is fine. Now let's start speed. So the task must be the marginal task rate. As I mentioned, it must be the task estimated on a value. It's like, and on a P&L, that's what we did, right? But then I just want to do some few confirmations. But for then, 2024 task has been estimated already, so I'll just go and pick 2024. But for 2025 going, it must be the marginal tax rate, and that means it must be 35%, and that includes the corporate tax plus then financial sector cleanup, and then the recovery levy. Okay, so we do 35%. Of course, it will be the same as what we have on the P&L, right? 35% times this. And we put a negative sign by this, and this is what we have. And this is what we have. So then earnings after tax, we tend to get earnings after tax, which is this to this. This is earnings after tax. We have this earnings after tax. Guys, let me pick my laptop charger, right? A moment. I'm back, and then I'm back. Okay, guys are still starting, right? Now, so we look for movement in statutory reserve. So with that, we go to the equity. We can just go straight to equity because we model all these things out, guys, right? So we go to equity, and we go to statutory reserve, and we look at the movement. So movement from here, 24, we put negative bytes because it's a reduction in equity, right? Reduction in profit, right? Okay. All right. So then we sum this up now, and this gives us the free cash flow to equity. So that's how we do this. And so we have free cash flow to equity. Nicely done here. Now, we will need to come up with some few things. Before that, if you are like me, I tend to dress my work really nicely, right? I want to dress things to look very good. And then the 2024 is my valuation year. So this is my valuation date, kind of like my valuation date, right? So valuation, sometimes I tend to write it here, or maybe I come below, and I can do a lot of those things. There are quite a number of things I'm going to write below. So let me do that quickly. I'm going to write some valuation assumptions. And valuation assumption. Ever since I started this lecture, I'd always, when I'm trying to type an assumption, I'll type R in place of T, right? So is the use of the marginal tax rate specific to the banking sector? If not, why not use the effective tax rate? Oh, no, the use of the effective tax, no, because this is a valuation, we are looking at a futuristic part of things. The effective tax rate in the past will not be relevant for this work because it reflects past cash flow, the path followed by the past cash flows. It's not specific to the banking sector. Oh, yeah. If you say specific to the banking sector, yeah, 35%, because that's 25% corporate plus the financial sector recovery levy plus the and the sector cleanup, something. So 5%. So 25 plus 5 plus 5, that's 35. Right. I don't know if I've answered your question. So let's put some few things here. Valuation date. And you recall what we wanted to use as valuation date. I mentioned that to you. the other day. The valuation date is, let me close this a bit. Let me close this a bit. Okay. The valuation date is 30, is 1st January. No, I think I told you it should be 31 December. Valuation date is 31 December 2025. Yeah, what's the valuation date we're using? Yeah, I need to format this, the date, the manner in which the date is displayed is quite scary. I have to change the date format. So I want it to be day, month, and year, something like this. Good. Yes, man. This is the valuation date. Oh, it has to be 2024. If you recall, when we're dealing with the discounted cash flow, the discount factor, I mentioned that, right? So valuation date is this. There are some few assumptions we need to put here. Cost of equity. The cost of equity, we'll look at it soon. Then the next in a sustainable growth rate. The sustainable growth rate will be needed when we are estimating terminal value, right? We will get the sustainable growth rate when we estimate terminal value. So with these assumptions, and let's create another worksheet where we do computation for cost of equity. And the whole thing is that we've done a computation before, so we're just going to bring that here. We did that the other day when, so let me see, cost of equity, cost of equity. We did that computation before. I believe I have those files. Just a moment, guys, as I pull out the cost of equity workings we did. I'll just copy them and paste here. A moment. Let me see something.
Hi, Julius. If you're saying something, you're on mute.
Oh, why did I mute myself? Oh, I cannot imagine I muted myself. Oh, okay. Okay, good. I have it here. You recall we did some computation using a Linus function and some kind of stuff, right? We're looking at cost of equity. Okay, so I've opened the two worksheets, so I can actually copy and paste directly. Okay, let me do that quickly. So copy and move the file to another worksheet, GCB bank workings, and put it at the very end. Copy. Good. I have my file here. So I don't even need this. I'll delete it permanently. Okay. So let me now share my screen. Okay, let me now share my screen. Okay. Please, can you see my screen? Is my screen visible? Yeah. Yeah. Okay, good. So we looked at this already. So cost of equity. Cost of equity So a lot of work has been done. The only thing left, I think we have size premium and company-specific risk premium, something associated with that. We yet to do that. And I told you that when we come to the discounted cash, we're going to look at that, right? Good. Those are the only things left here to complete this side of the work. Maybe let me change the color to yellow. So take the traditional color of GCB. Okay. All right. Cost of equity for GCB. This emerging market equity model. Here, I have to take off even this because we're actually doing a professional work for TCB going forward. Okay, so this is the cost of equity. We calculated that to be 27.79, and we yet to put in size and company-specific risk premium. Those were things left. But in the interim, we are going to link it. Let's link that. So we go pick the cost of equity calculated today, and we have this. We put this by rate, and this where we are with the cost of equity. Now, we need to come up with a sustainable growth rate. There are multiple ways to calculating sustainable growth rate, but there is a methodology that I want to use, and it goes like this. So let me even create two more slide things here so that I can do that. What I want to bring out here to be able to calculate the sustainable growth rate, two methodologies I can use. I want to come up with the average ROE. Average ROE, that's one. And then I want to come out with also dividend payout ratio. Dividend payout ratio. Payout ratio. Ratio. Okay, dividend payout ratio. Now, so these two, if I know the return on equity, and I know that, well, if I pay a portion of dividend out, then I'm going to remain, maybe I'll have a portion remaining, right? If I have 25% dividend payout, 25% out of earnings paid out as dividend, then I know I'm going to be retaining 1 minus 25%, which is 75%. That 75% will be invested to generate an ROE. So it's kind of like taking 75% times the ROE, and that becomes my sustainable growth rate for the bank. Now, this is the whole idea. In the long run, you don't expect the average ROE to be too high. So oftentimes what we do is that we use average ROE for industry. So in the long run, we expect these to move towards maybe the mean. But then also, so it's kind of like ROE is mean reverted, and we look at that also tomorrow. But then again, beyond ROE being mean reverted, the question is which measure of ROE we are going to use, and we say we're going to use the industry ROE. But the data we've been working with so far is for the top 5 banks. So let's work with top 5 banks up to tomorrow. Then we'll see whether we'll change this. Top 5 banks, ROE. That's what we use. And then we take the average dividend payout ratio of GCB, and then we'll be able to calculate the sustainable growth rate. So the sustainable growth rate is, so let's bring the average ROE here first. Average ROE for the industry, we go to the top 5 banks. We have them here. Top 5 bank ROE. No, I think in the objectives we should have it here. Top 5 bank ROE. This is ROE for the top 5 bank. Oh, profit after tax. We didn't calculate it. Yeah, we have a historical. So we are going to be using the historical numbers, right? Top ROE, top 5 ROE for the top 5 banks. So what we're going to do is that we are not going to include the DDP here. So I'm going to exclude the DDP period. However, somebody can say that the huge return on equities in the period preceding the DDP were actually driven by the DDP itself because of the regulatory forbearances and all that. So a rational thing to do would have been to base it on all, include the DDP period, so that it self-adjusts. When we do that, we got 35%, which is a figure that I think I'm looking at, right? The dividend payout ratio must be that of GCB. And here, we look at the average dividend payout, and we can look at that historically. We can use the historical figures, right? Or future. I would like to use future because I want the scenarios to change the dynamics. If the scenarios change, I want the dynamics to change. So I use the future. So I'll look for dividend payout for the future. And where do I get that? I go to the assumptions. Where we have the assumptions and the dividend payout. So I go to the live case. You know, the live case linked to the other assumptions. So I go to live and I'm going to look for dividend. Where is it? I have it here. So I'll get the average projected dividends. Or that is one thing to do. Or I can just base everything on the dividend payout ratio for 2025 and assume that the dividend payout ratio for 2025 is the dividend payout ratio that will persist going forward. But when that is done too, it's kind of like going to penalize. Now, wait a moment. Why should I even think like this? If I can use the dividend payout ratio for 2029, because what I'm going to calculate at the end of the day is the terminal value. And if I look dividend payout ratio projected for 2019, it's something which is close to the time, right? It's more relevant. So I use that. So I'm going to bring that dividend payout ratio terminal period or terminal year. Let me put it here into bracket terminal year. Dividend payout ratio into bracket terminal year. And let me see terminal year. Terminal year. Okay, dividend payout ratio, terminal year. So the sustainable growth rate here will be the return on equity multiplied by 1 minus the payout ratio. The 1 minus payout ratio is given as something we call the retention ratio, right? 1 minus payout ratio is the retention ratio, or is a portion or is a proportion of earnings that is retained. And that portion of earnings that is retained is will be reinvested to get at the return on equity to generate the same return on equity. This return on equity, you can argue with me and tell me that it's on the high side. I agree. I tend to agree that this is on the high side. Over time, maybe the bank's return on equity will drop, but how sure are you that it's going to drop or drop below the 35? How sure are you? So at the end of the day, we don't really know. Sustainable growth rate is this 26.8. Now, so how do we calculate the terminal free cash flow to equity? It's basically the terminal free cash flow to equity is basically the 2029 free cash flow. Then you're going to grow it by 1 more year. So it will grow at the growth rate you've calculated, the sustainable growth rate. So we have here. So the free cash flow will grow at this rate. And then, so this will give you the free cash flow for, let's say, the next year, which is 2030, right? We have that here, 2030. Then this will be discounted, or this will be something which will persist forever. So since it's going to persist forever, we're going to use the perpetuity methodology. And with perpetuity, we just divide by the cost of equity. I'm going to do that, but I'll tell you something again. You divide by cost of equity, and this is the present value of the perpetuity, as we have it like this. When you divide by cost of equity, that's the present value of perpetuity. However, wait a moment. This is a growing perpetuity. So since it's a growing perpetuity, we don't do it like this. You must subtract a growth rate from the cost of equity. So since the growing perpetuity, the value is going to be more. So we do the cost of equity, which is the denominator, then we subtract the sustainable growth rate from it, and it's going to bloat out now. So this is what we have as the present value of the earnings, or this is the value of the earnings beyond the explicit forecast period, or the value of the bank, beyond the explicit forecast period. So in other words, if we wait until 2029, we can sell the bank for 107 million. I'm not saying that's the value today, but I'm saying if we wait, all things being equal, if we wait to the end of 2029, we can sell the bank for 107 million or billion, because these are in thousands. The growth rate looks too high. Yeah, it looks too high, but then think about it. If you look at the growth in earnings, let me show you something. Let's see the historical growth in earnings for a bank. So growth in profit before tax. Look at it historically, 53%. Then 2022, the DDP setting, right? In 2023, it was a bit bad. And then 25% growth. Okay. Now, so what we are predicting is not too bad of a growth. Don't forget the bank was recovering from these years. So that's why they recorded these bad whatever trends. But it's not too bad, right? To project things like that. I agree to say the growth is too high. And let me tell you why you may be justified, or why the growth may be too high. And we may have to do something about it. The growth is too high because of the dividend payout ratio. If we adjust the dividend payout ratio up now, this growth will drop. Okay, that's one thing. If we adjust it up, the growth will drop. But now we are still setting the thing. And these things we are raising are concerns we'll be addressing on Wednesday. Wednesday, we'll actually evaluate the model properly. Now, so when we do this, we can then sum up things. We can either sum up things or leave them like that, the way they are for now. And then I think there's another question. Hi, Julius, you divided the terminal FCFE by the average ROA and not the cost of equity. Hope that's right. No, let me check it. Really? If that's what I did, then I'm wrong. Oh, really? Oh, then it's even going to be more, eh? Oh, look at this. It's going to be more. Wow. The growth rate is too high. Now, let's evaluate the assumptions behind this growth rate. Number one assumption is that we are saying that every one cedi that is retained is capable of generating return on equity of 35.8. Will this sustainable growth assumption work? That's a question we need to ask. Now, we'll come back to it. Let's complete our work. So periods, year 0 is this, then year 1, year 2, year 3, year 4. Oh, I might starting the thing from year 1, year 2, and in that sense, up to year 5. Okay. Discount factors. How do we calculate that? Let's check it out. So discount factors, 1 divided by, so 1 plus the cost of equity and raising that to the power the period. Oh, why am I even raising this to the power the periods again? So in other words, let me take, I can do that, but let me take off the 1 divided so I can have it this way. Then I'll put negative by it, right? I'll get the same thing. So when I do this, I'm going to I'll log this F4 to log the cost of equity. And then I drag this, and this will give me my discount rate. So this is my discount rate, or sorry, discount factors. Now, present value of free cash flows will be the free cash flow we estimated here multiplied by the discount factor. And then also we have the terminal value multiplied by the discount factor. So we can drag these two to the right, and that gives us this. Now, based on these, the intrinsic value of the bank would then be the sum of all these here. This gives us the intrinsic value of the bank. And that is this is what we have here as the intrinsic value of the bank. And then we have this. We can do these kind of like, let me do this, put on borders here, and then some borders here as well, right? Good. All right. So with all this, we have the intrinsic value for the bank to be this. So that's what we have. Or let me go back a bit. I want to take off a border, right? So let me do the borders rather around this alone. So this is the intrinsic value of the bank. And there are some few things that will have to be done. So we'll come here and see adjustments. So we may need to do adjustments to the intrinsic value of the bank. So what could be the potential adjustment or adjustment that we can do to this? And those specific adjustments, we'll spend time looking at them on Wednesday. So tomorrow, Wednesday, we'll spend time looking at those specific adjustments. So this could be adjustment to, so we can have the following adjustment. Let's say it could be the adjustment for FS exposure. No, but then the FS exposure to some of those things can be adjusted in the cost of equity in terms of company specific risk, right? So FS exposure will not be the best thing to do here. But then we can do adjustment for maybe loan loss, loan loss, potential loan loss, or not potential, but then to say loan loss. Maybe we review the loan book adjustment for loan loss. Maybe we do this review through due diligence. So out of due diligence, we're able to come up with this. Then we'll have adjustments for illiquidity or for liquidity, or we just apply liquidity discount. But then when we do the adjustment, we need to have a value before we look at liquidity discounts. So adjusted intrinsic value. And so the next thing we will do will be to look at, maybe come up with a liquidity discount. So we have, but one thing that we can do, maybe let's do that here, liquidity discounts. Sometimes we call liquidity discount or illiquidity discount. Illiquidity discount. So here, under the assumption, we can have illiquidity discount. And we can put that at, let's say, 10% to start with, right? So illiquidity discount will be this value we got in here times 10%. So we have that as a liquidity discount. So when we take that out of it, we have the maybe we can still call it the adjusted intrinsic value, right? Adjusted intrinsic value or intrinsic value adjusted for liquidity. Now, let me move these things down. And as I mentioned, this is the last one we'll do before we close today. So once we are done with this, we are closing. And then tomorrow, you move to the next one. So someone said, I mean, we should not include the 2024 FCFE in our calculation. Otherwise, we should. Oh, come on. Did I include that? Guys, did I include that? Oh, no, I included that. Oh, come on. I'm sorry about that. No. It's supposed not to. I just presented it there for reference purpose, but it's supposed not to have been included. I'm sorry if that is done. I'm so sorry. It's good that you guys are observant, right? Good. I shouldn't have done that. So good. Thank you very much. Spot on. Thank you. Now, so intrinsic value adjusted for liquidity. So then we sum this up this way, and this is what we have. Now, what to do next? We then put here book value. Maybe we will take a step down and say book value of equity. So this book value of equity will be the book value as at the end of 2024. So we go to the balance sheet and we pick the book value of equity at the end of 2024. So we pick that from a balance sheet, book value of equity 2024, which then is this figure here. We bring it here, this book value of equity. What am I seeing here? So you see clearly the problem with the workings we've just done because of the huge terminal value here. So don't worry, we just setting our method. For those of you who may see this and start panicking, just think about the situation where we have a sustainable growth rate of 26%, and we have an ROE for industry of 35%, and then we have a dividend payout ratio of this. Of course, the sustainable growth rate of this and cost of equity of this, the difference is too small. So that's the reason why we are having such huge jumps here. But another thing, we will do some sensitivity analysis soon, so you get to understand some of these things. I will often want to calculate the price to book ratio. Before liquidity discount, and then I'd like to calculate the price to book ratio after liquidity discount. After liquidity discount. And don't forget the price here I'm looking at is not your usual price to book. We call it a justified price to book ratio, and here to justify price to book ratio. Okay, so these figures are going to bloat out, guys. My concern here is not to get a very accurate one now. We're going to make a lot of adjustment to the assumption. So we are setting up our method. So let's get that right. So I take the adjusted intrinsic value. We have that here divided by the book value, which is this. It's going to bloat out, right? It's going to bloat out. It's going to bloat out. But that's not a concern here. And so I take the same, this one too, divided by the book value of equity. I got this. Okay. Now let me customize it quickly. So I have the multiples by them. So I go here, or maybe let me go to another one so I can have the multiples by them. Let me come here. So taking this and putting S. So we have this. And so these are further statistics on the market, further market statistics that we will need for our analysis. So we have the value of the bank justified by the fundamentals, all presented here. We have the valuation assumptions so we can actually vary the valuation assumptions to see how the rest of things go. If there's no adjustment for loan loss, there's no due diligence, however, then the value is the way it is. But we will by all means come up with this on the final day. The final day, which is Wednesday, we will look at all these things. We will make all adjustment to all these things. So this is the base case model, right? Now let me change the model to worst case and let's just check something. So go to objective. I am changing the model to worst case to see how the worst case distribution is like. So go to free cash flow to equity and look at worst case. It has dropped significantly. However, we are yet to even make a lot of adjustment to this, right? illiquidity discounts, 10%. Now, let me go back to the base case again. Let's check something. The base case. Now, so if I go to the free cash flow and I make the sustainable growth rate 0, going forward, the bank is not going to grow again. Let's see what happens. See what's happening. You see the drop. Okay. Now, let's also go back to change this from base to West, the West performance of the bank. This is the West performance as it stands. Ladies and gentlemen, let's also not forget that the cost of equity is not completed. So we are here to beef up the cost of equity because we've not put in size, premium, and company-specific risks. So let us not forget about that as well. That will throw the cost of equity into 30%, and that will have effect on whatsoever is happening here. So maybe let's leave things the way they are now with the sustainable growth rate being 0%. And there are things I do because I want to introduce other things for you to see. So that is it for today. God willing, tomorrow we will look at the residual income model, and then we'll compare the residual income model to the free cash flow model. And before we even continue, I'm not quite of a fan of the free cash flow model, even though we are going to work on the assumptions again, but I'm not quite of a fan of free cash flow model. And whenever I do valuation, I don't use a single method. I use multiple methods and I compare the result. So I'm not quite of a fan of the free cash flow model. I just wanted to know a little about that before we proceed to the the residual income model tomorrow. The residual income model is quite easy and is very nice and simple. We'll do that. Nelson says, hi, Julius. If theoretically growth rate is retention rate times ROE, why do we need to adjust the growth rate again? Wouldn't the adjusted growth rate be artificial? Oh yeah, the growth rate is artificial, but then if we want to say we want to adjust the growth rate, what we are adjusting actually is that we are adjusting the retention rate and we are adjusting the return on equity. So what measure of return on equity are we using? And what measure of retention rate are we using? You get a point. I assume that the dividend payout ratio will be 25%. What if it's more than 25% going forward? And I also assume that the ROE will be the average for the industry. What if the ROE is not average for the industry? And is that the industry ROE? That's one to say, because I'm looking at the top 5 banks, right? So what we can do is that we can rather extend this to look at the industry ROE instead. Look, tomorrow we'll handle all this, because we don't think GCP will continue to sustain that high ROE forever. No. At a point, the ROE is mean reverting. So at a point, ROE will get to cost of equity. And I'm going to prove that to you tomorrow. Not to say prove to you, but I'll prove to you tomorrow why the ROE is mean reverting. It will revert back to the mean. And I'll tell you what the mean value of the ROE is tomorrow. When we look at residual income, it will clear a lot of doubt again. So we'll come back to the FCFE model and then make the necessary adjustment. That's what I'm taking it the way it is today. So we've done a lot of work today, and that's beautiful. That's beautiful. Maybe let me delete this particular line. Okay. So oftentimes you can present your work this way nicely in Excel. It's nice, it's cool. And the valuation assumptions, let me do something like this, like a header, and then put it nicely in a table with borders. And yeah, something like this. It's fine. Is there a question there, Julius? Could you please share your cost of equity computation file with us? Yeah, definitely. Those should have been shared long ago. I've just been stubborn a bit. Those will be shared. Okay, so I will not share this particular worksheet today. I mean, okay, because we are not done. I don't want anybody to pick this and think this is GCV's value, right? By close of business tomorrow or by close of lecture tomorrow, I will be able to share this one, because by then we should have the final values that we can perform simulation analysis on. Not even tomorrow. We will wait until Wednesday, because Wednesday we should be able to complete everything with a scenario analysis, Monte Carlo scenario and all stuff. So then we see how things go. Any question? We've had a wonderful time today. Any question? I want to give you an assignment. I want you to, tomorrow before you join, look at this, take a look at GCB's 2024 annual report and see whether there are some few things out there that we can make adjustments to, right? We can adjust. Check it out. And before we meet tomorrow, I want you to take a closer look at the annual report. I hope it's something we can do, right? Good. Thank you very much for joining. Ifri, as usual, let's hear from you before we leave here. Hi, Ifri. I hope Ifri. Guys, let's hold on as tradition demands. Let's hold on to hear from Ifri. Okay, Ifri.
Hi,
Do you
Julius.
plan to compute the terminal value based on multiple? Yeah, plan to, sorry, excuse me, Ifri. Yeah, plan to compute the terminal value based on multiple. In fact, that's a better approach as well. And so that's why I said today is just, I set the first methodology, right? We don't have more time to get into it. So tomorrow, we are going to look at the terminal valuation calculation to base on multiples to see how it works. So tomorrow, we will work with some multiples. Okay, thank you very much. Ifri, please proceed.
Okay. Thank you, Julius, and thank you everybody on the call today. We will be back tomorrow, same time to continue. And Wednesday will be our last day. We would share the slides and everything that in a compact, all together. I mean, for everybody to have a look at, and also the videos are available on YouTube, so you can refer to them any time that you need a refresher. Okay, so thank you everybody and enjoy the rest of your evening and see you tomorrow.